Imagine this. Two families buy life insurance at age 30. Family A buys term life insurance for $40 a month. Family B buys indexed universal life insurance for $400 a month. 30 years later, Family A's policy expires with $0. Family B now has hundreds of thousands of dollars in tax-advantaged cash value while still maintaining life insurance protection. Same goal, same starting age, very different outcome. So the real question is life insurance only meant to protect your family, or can it also build wealth while protecting your family at the same time? Today, we're breaking down the truth about term insurance versus permanent life insurance, including whole life, universal life, indexed universal life, IUL, variable life insurance. And by the end of this video, you'll understand why many financial professionals and wealthy families prefer IUL. Let's dive in. What life insurance is really for. Before comparing policies, we need to understand the core purpose of life insurance. Life insurance exists for one reason: financial protection. If something happens to the breadwinner, life insurance ensures the family can still pay the mortgage, cover college tuition, replace lost income, pay debts, maintain their lifestyle. According to the Life Insurance Marketing Research Association, LIMRA, 44% of American households would face financial hardship within 6 months if a primary wage earner died. That means nearly half of families are financially vulnerable. But here's where the financial industry splits into two major philosophies: protection only, or protection plus wealth building. And this is where term versus permanent insurance comes in. Term life insurance explained. Term insurance is the simplest form of life insurance. You pay for coverage for a specific period of time. Common terms include 10 years, 20 years, 30 years. If you pass away during that term, your beneficiaries receive the death benefit. If you outlive the policy, the coverage ends. No payout, no savings, no cash value. Pros of term insurance. Term insurance is popular because of three major advantages. 1. Very affordable term policies are the cheapest life insurance available. Example, a healthy 30-year-old may get $500,000 coverage for around $25.40 per month. This makes it accessible for families who need immediate protection. 2. Simple and easy to understand. Term insurance is straightforward. Pay premiums. If death occurs during the term, the family receives the benefit. There are no investment components or complicated structures. 3. Good for temporary needs. Term insurance works well when financial obligations are temporary. Examples: covering a mortgage, protecting young children, income replacement during working years. Cons of term insurance. While term insurance is affordable, it has several major drawbacks. 1. It eventually expires. Most people buy 20 or 30-year term policies. But what happens after 30 years? The coverage ends. And statistically, this is when people actually need insurance the most. According to the U.S. Social Security Administration, the average American life expectancy is 76 to 79 years. Most term policies end when people are 60 or 65, meaning many families become uninsured during retirement years. 2. No cash value. Term insurance builds no financial asset. All premiums go toward insurance costs. When the policy ends, you walk away with nothing. 3. Renewing later is extremely expensive. Renewing term insurance after it expires can be shocking. Premiums can increase 10x or more because insurance costs rise with age. A 40 policy at age 30 could exceed $500 or more per month at age 65 when you only have a fixed income from retirement. Now, let's discuss permanent life insurance. Permanent life insurance solves the biggest problem with term insurance. It never expires, as long as the policy is funded properly. Permanent policies also build cash value, which grows over time. The main types are whole life, universal life, indexed universal life, IUL, variable life insurance. Let's break them down. Part 4. Whole life insurance. Whole life is the oldest form of permanent life insurance. It has guaranteed premiums, guaranteed death benefit, guaranteed cash value growth, pros: stability and guarantees. Whole life policies offer predictable growth. Many policies grow around 2%, 4% annually, depending on the company. Some mutual companies may also pay dividends. Cons: low returns. Compared to market-linked strategies, whole life returns are often modest. Over long periods, this can significantly limit cash value growth. Limited flexibility. Premiums are typically fixed and must be paid consistently. Adjustments are difficult. Part 5. Universal life insurance. Universal life introduced more flexibility. Policyholders can adjust. Premiums. Death benefits. Cash value earns interest based on insurance company crediting rates. Pros: flexibility in premiums. Potentially higher returns than whole life. Cons: interest rates can fluctuate. In low-interest environments, policies may underperform projections. Some older UL policies collapsed due to declining interest rates. Part 6. Variable life insurance. Variable life allows policyholders to invest cash value in market-based subaccounts, similar to mutual funds. Pros: potential for high returns if markets perform well. Cons: higher risk. Cash value can decline during market downturns. Policyholders bear the investment risk. This volatility can create problems if market losses affect the policy's ability to cover insurance costs. How about indexed universal life, IUL? This is where things become interesting. Indexed universal life combines insurance protection with market-linked growth potential. Instead of investing directly in the market, IUL cash value is linked to indexes like the S&P 500. But here's the key difference. You participate in the gains, but are protected from market losses. How IUL works. IUL policies typically include a floor, usually 0%, a cap, often around 9%, 12%. Example: if the market gains 10%, you may earn up to the cap. If the market loses 20%, your credited interest could be 0% instead of negative. Advantages of IUL. 1. Downside protection. Unlike investments, IUL policies typically protect against market losses. Your cash value cannot decline due to market performance. 2. Tax advantages. Under U.S. tax law, IRC 7702, life insurance policies can grow tax-deferred. Policyholders can access funds through policy loans, often tax-free when structured properly. This creates what many call a tax-advantaged retirement strategy. 3. Flexibility. IUL allows adjustments to premiums, death benefits, contributions. This flexibility helps policies adapt to life changes. 4. Living benefits. Many modern IUL policies include riders. 4. Chronic illness, critical illness, long-term care. A very important benefit. This allows policyholders to access the death benefit while alive if serious health issues occur. 5. Wealth accumulation potential. Because of index-linked crediting strategies, IUL policies have historically produced higher long-term potential than traditional whole life. This makes them attractive for retirement planning, tax diversification, legacy planning. Why many financial professionals prefer IUL. Indexed universal life sits in a unique position. It combines protection, flexibility, tax advantages, market-linked growth, downside protection. Few financial vehicles offer all 5 simultaneously. This is why many financial professionals use IUL for strategies such as tax-advantaged retirement income, wealth transfer, business planning, college funding strategies, supplemental retirement income. Important disclaimer: no financial product is perfect. IUL works best when designed properly, funded correctly, held long-term. Like any financial strategy, it should be part of a comprehensive financial plan. Conclusion: so what's the real difference? Term insurance protects your family temporarily. Permanent insurance protects your family for life. But indexed universal life goes a step further. It allows families to protect their loved ones while building tax-advantaged wealth. And in today's uncertain economy, that combination can be incredibly powerful. If you found this helpful and want to learn more about how families build a strong financial foundation, subscribe to Cloud and Skye Finance. And if you'd like a free financial strategy session, check the link in the description below. Because the truth is, the earlier you start planning, the stronger your financial future becomes. Thank you for watching and supporting our channel.